Today we're answering the question, should I sell my investments and go to cash? Welcome to YCG, where we make your capital grow so you can achieve your financial goals. If this is something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO at YCG. With the pandemic and recession that we're currently experiencing, financial markets have plummeted, and we've witnessed unprecedented government stimulus and Fed action, which has likely helped the U.S. financial markets recover somewhat. Selling now seems like an obvious thing to do, right? You can go to cash by selling at higher prices. Then when the market drops again, you can reinvest your money at lower valuations, following the old adage of buying low and selling high. In most scenarios, you should not sell right now. But keep watching because there is at least one reason you may want to move some of your assets to cash. But it's not for the reasons you may be thinking of right now. So the first reason why I don't think you should be selling right now is that you should not panic. Stock prices reflect what people are currently willing to pay for a business, but don't necessarily reflect the company's actual intrinsic value. For example, say you're at home and you get a knock on the door. You love your house and you've owned it for a few years now. You paid, let's say, $250,000 for it. So you open the door and a stranger stands there and gives you an offer to buy your house for a mere $100,000. Would you panic in that moment and sell it to the stranger at his bid price? No. You know what your house is worth, and you're in a position where you don't have to sell. So what do? You decline the stranger's offer, you close the door, and you go back to watching your movie. Now, if another stranger came and knocked on your door and offered you $750,000, now you might be interested in selling perhaps. But again, no one can force you to sell your house. But the point is, the stock market and the prices that it gives you are there to serve you, to help you know when the right time is to buy or sell. They don't give you the true intrinsic value of your stock or the business ownership you have as a stockholder. What matters most is, does your business have enduring pricing power and consistent cash generating qualities that have a high percentage shareholder payout? Another point that many investors forget is the tax implications of selling and realizing capital gains. If you own a stock in a taxable account, like a personal or joint account, depending on the size of your gains, you could incur some pretty sizable taxes owed come April next year. Taxes are a real drag on your investment performance, and you can't afford to ignore this important factor in deciding whether or not to sell your investments. The government gives you a massive incentive by not taxing you until you sell. So until then, your investments can grow and compound the longer you remain invested. Another reason not to sell your investments is this concept we here at YCG called the investor behavior penalty. A study was done many years ago where they compared the investment returns over a 30-year period. The average fund return was 9.9%, but the actual fund investor returns were a mere 3.8% annualized returns over that same time frame. So what was the difference? It was the investors buying and selling at inopportune times. They were trying to time the market, and it significantly reduced their overall investment returns. Remember, over a long period of time, the stock market has a positive expected value. The key is to get on the investment train of owning high-quality businesses for a very long time and do all you can to not get off the train. Another point to mention why you shouldn't go to cash is for the simple reason that our government is printing money and devaluing the American dollar. Cash is not a good long-term asset class or investment. I've spoken on this in another video you can check out here. If you're in cash, you could lose your purchasing power by inflation. We're here to help you increase your purchasing power in the future by investing in stocks that we believe will perform well over the long term. I've talked about a lot of reasons why you shouldn't panic and remain a long-term stock investor. Working with our clients, some of whom have been invested for over 40 years, is a constant reminder to me and gives evidence of the wealth creation that comes about by being a patient, long-term investor. Deep down, that's what you want to achieve and what we're all about here on this channel, making your capital grow so you can achieve your financial goals. However, like I said earlier on, there is at least one reason you may want to sell and raise a little cash. Emphasis on the little word. If you're in retirement and you live on and depend on your investment portfolio, then having enough cash as a rainy day fund, which would cover your living expenses in excess of 1 to 2 years, in my opinion, is very prudent and wise. You're now dictating when to sell, and you won't put yourself in a position when you're forced to sell your investments at a bad time. In this case, even if the market goes down from here significantly, you can remain invested knowing your short to intermediate cash needs are met, and you can ride out the storm, which will surely pass. If you found this video helpful, then click on one of these other videos so you can learn more. If you have any questions, then please leave them below. We'd love to hear from you. Thanks for watching, and we'll see you in the next video.